Hello, my friends. This is Doug Fabian. Welcome to the weekly ETF report. Today is Thursday, June 25th, 2015. Thank you for joining me today. Three things as always. Let's begin with a review of the global picture in stocks. I have to share with you a chart that shows SPY, the S&P 500, EFA, the developed markets, and EEM, the emerging markets, on a year-to-date basis. Now, this chart shows you how these different markets are performing. The red line, EFA, is up about 10%, and SPY and EEM are up about 2% so far this year. So, international stocks, which are being aided by the European Central Bank's quantitative easing, and the Bank of Japan, the Japanese stocks, benefits from quantitative easing. You know, there is no central bank for emerging markets. So emerging markets are somewhat tied to the U.S. and what happens with interest rates in the U.S. And there's a lot of concern about interest rates going up in the U.S. So this is the reason why emerging markets have kind of settled back down a bit and corrected over the past couple of months. But that's the scoreboard so far this year. International is outperforming U.S., and the U.S. market is positive so far this year. But point number two of today's discussion is volatility. And I'm just going to talk about the U.S. stock market. In the past 6 weeks, we've only had 2 stock market days where the market has moved up or down more than 1%. In the past 6 months, you have to go all the way back to December, where you had a single day when the S&P 500 was up or down more than 2%. If you take a look at the last time we had a 10% correction, you have to go all the way back to October of 2011, 3.5 years ago. And when you think about a 20% fall in stocks, you've got to go back to 2008, 7 years ago. Well, we've had this narrowing of risk, narrowing of volatility. And the reason why I'm bringing this up is because it's created this level of complacency that I think can be a dangerous thing. Because we're going to go through another period of high volatility where stocks rise and fall quickly. And that's when people make bad investing decisions. Now, this brings me to the last point I have for today. And I have 2 charts to share with you. The first is the S&P 500. Looking at this chart of the S&P 500, you can see that over the last 6 weeks or so, we've been kind of going sideways. But the U.S. market's still near a 52-week high. We're down about 1.5% from that level right now. Just sitting right above the 50-day average, but still above the 200-day average, which we've been above since October of last year. If we break the 200-day average, that is an early warning sign of higher volatility ahead. Now, the second chart I have is a chart of all stocks in the world, including the U.S. The ticker symbol is VT, Victor Tom. This is a Vanguard product. It's the, all country ETF. And you can see it's topped out about a month ago, just below its 50-day average, still above its 200-day average. And I'm giving you these, kind of looks at the price movement of stocks because it shares with you what the current trend is. Short-term trend, you could say, in stocks is down a little bit. But long-term trend still positive. And we haven't violated any of these key indices, 200-day moving averages. So that's the concept I want you to pay attention to going forward. A reminder, if you're not a subscriber to Successful ETF Investing, I would encourage you to become a subscriber. This is where we give you weekly email updates, a monthly newsletter, alerts on buys and sells in our 3 different ETF portfolios. And right now, I'm very focused on helping subscribers identify new opportunities in exchange-traded funds. This is Doug Fabian. Thanks so much for tuning in this week.